Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening each and every week. We are on a number of different stations in a number of different states, 5 stations in 3 different states, as well as 8 different podcasts, all the major podcasts. We're on YouTube. If you want to see the show, you can tune in and see the show, Jeff Barton, the Mortgage Voice. We also do this LinkedIn and Facebook daily, or really 2 or 3 times a week show, which we update as to what's going on. There is some things going on in the marketplace. The most important thing is what's happening in the Congress right now, whether they're going to impeach or not impeach. But it holds up the business of Congress, which is to obviously, at this point in the Biden administration, approve most of the people working for Biden, as well as to look at some of the major legislation that's in front of them as it affects housing, as it affects mortgage rates. Mortgage rates, not so much, because the availability of funds really doesn't emanate from anything that the Biden administration or any federal administration, other than the Fed itself, which is an independent organization. Those people, they set monetary policy, and that monetary policy is then turned into money that's available to businesses that can then lend it out, or to major businesses to borrow from big banks. There's about 5 to 10 big banks that borrow from the Fed. But all that, what does it mean? It means we are in a holding pattern here until these things occur. The major legislation, of course, is the legislation that has to do with the stimulus package. Stimulus package for us in the mortgage industry has to go along with jobs. There's still 10 million people out of work. That's not a good thing. 10 million people out of work. And I'll just set some numbers for you. Prior to, last January, February of 2020, before the pandemic, which hit in March, as everyone knows, there were 152,523,000 people working. Now, that was a record. Amazing, right? When you think that of a country of 330 million people, only half are working. Well, that's, you got kids and old people and retired. And yeah, so and of that big number, there's probably only about 75, 80 million that actually pay federal taxes. So you're bearing the brunt. Thank you very much. I'll have another. So this come the 20th, 2021, January 20th, the number of people working are 142,631,000. That is a net loss of jobs in 1 year of about 10 million. It's 9,892,000 people. So what happens to those people? Now, we've seen these numbers come down throughout the year, but at the start of this year, this is what the new administration walked into. That's why the stimulus package is so important, because the payments directly to people, especially people who aren't working, is so greatly important to maintain spending, to maintain the economy at the current clip. We saw the economy not dip as much as we thought it was and was going to. And this year we see the economy improving quite a bit, especially when the vaccines get rolled out. Now, how are the vaccines doing? Daryl, do you know what the latest count is nationally? How many vaccines have been ordered? How many have been taken?
Not right offhand, but it's running about 30%, the amount taken versus the amount being sent out.
That's right. It's about 63 million have been sent out. About 23 million people have been vaccinated. So we anticipate in another 6 months, we will have a lot of people vaccinated, which means that the economy will open up. Now, there are many people who feel that the economy will open up booming, but there are a net amount of jobs that will never come back. And some of the real estate around the country has really suffered as a result of people realizing, hey, we don't need that big office. We're going to send people home and keep them home. This is all affecting the mortgage and real estate markets, and how it's going to affect the real estate market going forward is if the economy picks up and we do get that boom or flash economy that we're expecting after July. The demand on housing is going to be a lot more than it currently is. Now, it is high right now. Demand on housing has put it that we are experiencing double-digit increase in value of properties throughout the country from year to year. So January of last year, your property was worth 10% less than it is today. That's basically what's happening. Now, is that sustainable? No, of course not. It's not sustainable. But one of the things that is different, and people ask me, oh, well, there's a bubble, and there are bubbleites out there. There are people out there who are doom and gloomers. Now, I've read a number of different things that talk about why this is different than then. Now, there are similarities, of course, rising real estate prices, um, the uh, the way that I guess people are earning a living, the fact that there are, how many millions, 5% of the mortgages out there are in forbearance. This is a bad thing. The good thing is, and there are three of them, and this came out from Housing Wire, and I'm just going to read it off to you. One, when the loans were gotten before COVID, the borrower had high FICO scores. Now that is different than when we were in the past recession in 2008. Those borrowers were borrowing on the if-come, on the ability, or I guess the way the market is going to increase in value, and it was increasing, 10% per month. We're talking 10% per year here. But the difference being is that the FICO scores in this particular market are way higher than they were back in those days. Number two, low interest rates. The low interest rates right now are affecting the market in a positive sense. What it means is more people are allowed to buy, even though the prices are high. When the market turns, you're still going to be able to afford the payment because the actual cost of the loan is so low. And number three is the growing equity in people's homes. If you have a job and have a mortgage, the equity in your home just grew 10% last year or thereabouts. If you don't have a job and own a home and are in forbearance, your property gained 10% in value last year, which means that you're less likely to go into foreclosure because you have more money in your property. Worst case scenario, you sell the property. But we don't know what's going to happen with the forbearance. We do believe that when people get back to work, i.e. in July, that people will be able to start paying the mortgage again. What happens to that year? My feeling is it's going to get tacked on the end. So if you had a 30-year mortgage, now you're going to have a 31-year mortgage, 2021, like that. They're not going to make you pay it all at once. They're just going to add time to the end. How that's going to be done, what legislation has to be done in order to ensure that. But there is just no chance that somebody who's, not had a job, has been trying to struggle to get by, who's waiting for those stimulus checks, and that's why it's so important to get them, to make sure that these people are not destitute, that they are able to pay other bills, that they are able to stay in their homes until we get them back to work, which again, we're all anticipating a good number of these people will get back to work. There are a lot of problems in that scenario as I describe it, but that's the way I think it's going to run. Because I don't think that they need bipartisan support on the Hill in order to get those particular legislative packages through. I think they can be slammed through by the Democrats only, and I would say get it done quicker rather than later, because as momentum builds against anything Democratic, as it did during the latter half of the Obama years, and if in the 2022 elections Republicans come back, well, you can see, legislation takes time. Bipartisanship takes a lot of time, which is why getting this package through quickly, as they did back in 2008, when Obama came in, they passed the TARP, the Toxic Asset Repurchase Program, or something like that. And that was almost $1 trillion. Now, this current program that they're calling is going to be almost $2 trillion on top of the $900 billion on top of the $2 trillion. So it's going to be $5 trillion in a year. But will it save the economy? We don't know. Will it make inflation hotter? We don't know that either. I tend to believe that the way the rest of the world is responding to this will be more about how it is affected here rather than what we only do for ourselves. Meaning if, hey, we're the only game in town that you can buy bonds and still make money, people are going to buy bonds here, which means they're buying your debt, which means that the inflationary cycle that some people say may happen, may not happen. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for tuning in. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show each and every week. We bring you some highlights, some lowlights, whatever's happening in the mortgage and real estate businesses that are going to affect your decisions to whether you're going to buy, sell, hold, whether you want to refi. The market itself always changes, and it's always interesting because, especially with the change in administrations, what's happening in Washington today during these impeachment proceedings, it's just interesting because it affects people's sentiment. People's sentiment are really what drives the market. If you feel good, you're probably going to spend money. If you don't feel good, you're not. So how do you feel today, and where are you? Real estate market is tight. Mortgage market is low interest rates. So that particular combination, how does it affect? We bring to the show all the time different people who can help us understand what's going on around the country. It's not just California centric where we record the show. Radio stations in Albuquerque and Las Vegas, up in Central California, as well as in the south of the state. We bring LaWanna Bradford from the Bradford Group from Atlanta, Georgia, another state that Malibu Funding is licensed in, to give us some idea of what's happening there. LaWanna, how are you?
I'm doing great, Jeff. How are you? Thanks for having me back again.
Thanks for coming back on. I'm okay. I'm a little COVID crazy, but I guess one thing that I'm not is I'm not constantly listening to radio and TV about the crazy goings on in our federal government. I've actually been bored to tears, which I relish. I actually like the fact that it's calm and I can get back to just focusing on what I do and what you do. How is it there in Atlanta?
Things are good, and just like you have to pull back from
Yep.
all the noise because it can become overwhelming.
I totally agree. And your particular state there in Atlanta really tipped the balance of not only the general presidential election, but the Congress as well. You must be feeling pretty, I don't know, involved, happy, sad. I don't know. You've got some emotions going on, I'm sure.
I feel a sense of calm that wasn't there previously.
Right. Well, I want to get into what's happening in the market, the real estate market, mortgage market in general. There, is it as on fire real estate wise and with low inventory as it is everywhere else?
Oh yeah, we definitely have inadequate supplies, and property values are increasing, because of the increased demand that's there. So that's good. But the conversation now is there going to be a forbearance crash that we may experience in third or fourth quarter of this year?
That's interesting. First part of the show, I talked some about the argument against the forbearance crash. One of it was that there's a lot of equity now in these properties that are in forbearance, even though they're not paying the mortgage, but the unemployment is high. Is it high there in certain groups?
Yes, it is. The same industries that have been hardest hit, across the nation, we're no different.
Right.
Those in the service related industries.
Yeah. But one of the things that I note is that most of these people in service related, they're not homeowners, they're renters. Now, there may be a rental problem, and there certainly is a rental problem. But when 2007, 2008 happened, did most of the properties in foreclosure then, were they purchased by large companies who are just renting them out now and holding them? Or were they turned back into single family residences that were bought and sold again?
Turned back into single family, bought and sold.
I see. So that means that
that's their haven here for quite a while.
Right, I'm sure it was. Tell us a little bit about your business. What's happening with the Bradford Group?
Well, the Bradford Group, our focus has actually been largely on 1 to 4 unit investment right now. And the one challenge that we've had, the biggest challenge, has been with our commercial clients. And just our lending partners have tightened the guidelines. I guess they're so big based upon the type of business, if that business is still going to be able to maintain, or will they end up defaulting on the loan. So we've had some challenges there in just working with our lending partners. In fact, I was talking to one last week, and he's like, "Oh, we've got a new guidelines. We call them COVID lending guidelines." Like, this is getting beyond ridiculous. So,
Well, that debt service loan, are you using that with some of your clients? The ones that if the rents cover the mortgage, then you don't have to show other kinds of income? Is that a popular loan in Atlanta?
I have one lender that will do that, but it's not terribly popular.
So what is the financing on the 1 to 4? I assume they're 1 to 4. Maybe they're over that. But what are you using currently as your means to finance that kind of property?
They're using, as far as the qualifications, they're using bank statements.
I see. And these business bank statements?
The ones they were at requiring 2 years, now that's the one good thing. Now they're only asking for 1 instead of 2, but then the credit requirement has increased, and the amount of reserves is now increased.
Okay, it's reserves, but not down payment, right?
Right, reserves, correct, not down payment.
And are those cash reserves or those asset reserves?
Cash reserves. They want.
I see. Okay, so in this 1 to 4 investment type client that you're using, are they seasoned, most of them? It sounds like it's, a type of market whereby if you're seasoned, you have a better chance than if you're trying to just bust into it now because there's such demand on these 1 to 4 units. Right.
Yeah, the more experience that the borrower has, the better the relationship is with that prospective lender. They definitely want to see someone who's done it before, who currently owns their primary mortgage as well. They just want someone who's buying property and renting for their residents, and they're looking for at least 2 years history. If they're fix and flip, or if they're buy and hold.
I see. Tell me a little bit about what the inventory is like in these kind of properties, and then what the costs are for a property like that. I guess it's different in different parts of the city, but maybe you can give us an idea about what the prices are and availability.
Yeah, Jeff, that's like all over the map. So when you're more in the urban center, your prices are going to be a lot higher, ranging from $150 and up, and typically that's going to require a little bit of work, cosmetic work.
Yeah.
The further out you go, you know what I'm saying? I'm looking at like a starter type home. The farther out you go, you're going to get for that same price a little bit more home, a little bit more land, but the pendulum swings as far as what the property values are going for.
Do you see the rents themselves that are promised, if it's a vacant property or if it's a full property, do they impact the loan at all, or are the lenders scared about renters not being able to pay and going into some kind of renter moratorium?
When they look at the loan, if the property is going to be a buy and hold, and if it has an existing tenant, they'll use the current rental, and then when they do the appraisal, they'll see what the fair market value is for that rent. If it's something that's vacant, then they're going to just apply that fair market value in their overall evaluation to qualify that loan.
I see. Tell people how they can get in touch with somebody like yourself, a great real estate and mortgage person in Atlanta, Georgia, if they're planning to move down in that area or looking for some investment.
Sure, they can definitely reach us at, I'll give you my phone number first, 404-618-2824. That's 404-618-2824. Or our website, that's Bradford Group MTG, Bradford Group MTG, like mortgage.com.
And one quick question, we have about a minute left. When you're sizing up clients, what's the main thing you look for in their financing? Reserves, FICO score, job? What are you looking for, especially for an investment property?
I look at what's their why. What are they trying to do? I think once I understand that story, if they're looking to buy and hold, if they're looking to buy and sell, what's their long-term horizon with getting in the investment arena, then it helps me to guide them to the right type of product that will fit them. Actually, believe it or not, credit is the last thing that I pull on any borrower, because I really want to have a conversation and understand, the nuts and bolts behind everything that they're doing. And then when I feel like, okay, this sounds like it's a good fit and we can service you, then we'll pull credit.
Okay, excellent. Luana, thanks very much for coming on the show once again, giving us an update of what's happening down in Atlanta, and good luck this first quarter or so. We'll see what happens.
Thank you so much, Jeff, and you take care of yourself. Stay safe.
Thank you, and you do as well. That's Luana Bradford from the Bradford Group in Atlanta, Georgia. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for coming to the show, for listening to the show. Each and every week, we bring to you information about mortgages, about real estate, about things that you're going to need to know if you're going to make right decisions, good decisions, when buying and selling, when getting a loan, when getting a refi. It's an exciting time in real estate, although the product is really scarce. So if you've got something you want, best thing to do is to get the best loan. And to talk about that from Mortgage Solutions is Richard Impietro, who's been on the show several times. Appreciate him coming back again. Richard, how you doing?
I'm doing great, Jeff. Thanks for having me.
Thank you very much. Okay, describe to us the best program you guys are offering right now in this very difficult market.
Okay, our programs are probably not the mainstream. We do government lending. That is our niche. We focus on the opportunity to help borrowers with substandard credit, basically. FHA allows a borrower to go down to 500. So we will follow the FHA guidelines without any overlays that they're often referred to. So that can help quite a few borrowers that are below 620 that might not be able to get a conventional Fannie Mae or Freddie Mac loan. Similarly with the VA product, as many of you may be aware, it's a very attractive program for the veterans, allowing them to do 100% financing on their homes and up to 90% cash out. Again, there's no minimum score, FICO score required on a VA loan, so you could even go below 500 in some cases. Those often involve what they call manual underwrite, which we do those as well here. And we also do the USDA loans. And in any of those products, you could even have a manufactured home in any one of them. So that's primarily our niche. We also have a unique product for people that seeing more and more now that want to move into more rural areas. Something north of 5 acres up to 300 acres. People want to buy small hobby farms now, and maybe have some producing income on them and things like that. We do those types of programs too.
Well, that's interesting, especially given the fact that there's been a flight from a lot of major cities to try to get away from, I guess, other people, for lack of a better thing to say. I mean, COVID has really affected the way people buy homes, work at home. Working at home obviously means you need more space. And how does one qualify that differently than one would qualify for a conventional loan in a regular or a more urban area?
Well, for a hobby farm, where there's actually a home on the land, and there may be oftentimes avocado trees, pistachio trees, even horse properties, things of that nature, they'll still use a debt-to-income ratio.
Okay.
It's total debt divided by your income, and they'll arrive at a number that they would deem acceptable. Under the commercial farm program, it's a little bit different when you talk about, larger farms and ranches. Or what I get a lot of calls on is raw land. People
Right.
are looking to buy a piece of land right now. Again, if it's an agricultural type of land, that type of loan is qualified based on what they call the total debt coverage, which is primarily your, assets and your total debts, and come up with a ratio based on, how many total asset dollars you have to your total debt dollars, in essence.
Okay, interesting. Only because I know a lot of people can't get those kind of loans, haven't been able to get those kind of loans, and want to get out, either, like you say, build on raw land, or buy something, what you call a hobby farm. I love the term, because I'm no farmer, but I grew up around a lot of animals. You know what I mean? So I think a lot of people like that idea. It's just, can I qualify? How do I get a loan? I want to get back a little to the FHA product, and you talked about a low FICO score. What the risk evaluation on that, by I guess FHA? How do they look at that, especially in a situation where usually on a low FICO score you're dealing with someone who who hasn't been able, for whatever reason, to maintain a higher FICO score, either paying the bills or they get behind on medical or whatever it is. In a COVID situation where employment is obviously paramount, how do they weigh the risk between low FICO score, employment? Just give me a little bit of insight into the risk analysis that you make every day when you're talking to, I guess, loan officers around Southern California.
Sure. Whenever you're doing a government loan, the attraction obviously is the minimum down payment. You can do a government loan with as little as 3.5% down, meaning FHA, or the VA, you can do it 100% financing. So that's the attraction. Whenever your scores go below 580, then FHA would require 10% down. So
I see.
That's where the risk, as you said earlier, gets a little mitigated for the investor, in this case, HUD, where they will require more down payment if you go below 580. We have a, standard approach to all loans, which is using an automated underwriting engine, desktop underwriter in many cases. Some people use Loan Prospector. And those engines will deliver what's called an approved eligible, oftentimes. But the loans we do, most of the time, they get a refer. They don't get it approved. And a refer means you have to do a manual underwriting. And so when you start doing manual underwriting, there are certain underwriting criteria, evaluating that risk, that's a little bit different than when you get an approved eligible. And that would involve, lower debt to income ratio requirements, potentially, showing at least 1 month of assets in the bank to cover your PITI, and some limitations on, how many times you can be late in the last 12 months on some of your debts.
Right.
Specifically, if you want to do a cash out, you cannot have any lates on any installment or mortgage debt in the last 12 months, which is a pretty popular product to do a cash out.
Right.
With FHA because of the lower FICO scores.
Absolutely. Do you see your mix more refinances now? I guess everybody's doing a lot of refinances, but because you offer some product that are really attractive for purchase borrowers as well, what's the mix of purchase to refi that you're doing at where you are now?
We're seeing probably about 60-40. It's 60% being refinances, given that. I mean, it's funny to say this, but interest rates have gone up a little bit in the last couple weeks. The 10-year, was down below 30 basis points. Now it's maybe 100 basis points. So, there's been a spread there, which has impacted the flow of refinances to some extent, as people always have to adjust to these increases, even though they're, obviously historically low levels, no matter how you look at it. But nevertheless, you can see in 2.5, 3 in some cases. Those are typically not the rates you see when you have a lower FICO score. You're usually looking in the 3.5 range, maybe to the 4 range now, because of the additional costs associated with the lower FICO scores. So that's, kind of what you could expect when you start talking about the government loans.
Now, I don't know whether you watched the Super Bowl. There were a couple, three ads about mortgage brokers. Your business works with mortgage brokers. Do you find it's easier to work with a mortgage broker in this particular climate where, it's just, it's very difficult to get real estate agents into properties with their clients because there's so few of them? What are you thinking about that?
Yeah, I noticed, Rocket Mortgage and a couple others had those ads promoting the broker community. I think there's a sense that the broker community will continue to expand. As you know, it took a pretty big hit in 2008.
Yes, it did.
Crisis had quite a bit of reduction in the number of brokers. That's been expanding ever since. So I think there's a more of aggressive attitude toward being able to work with mortgage brokers and the relationships that they can bring. Personal choice. I mean, obviously, mortgage broker has access to a lot of lenders. That's right. Their benefit. When you go to a bank, that's what you get. You get the bank.
Right. So that's right.
It's obviously a rate conscious type of product. We're in a commodity business, so brokers can shop for you maybe a little bit more, and you can compare against that bank. Could be one approach to it.
Hey, Richard, could you shout out a phone number for people to get in touch with you, especially on these great products you've been talking about?
Yeah, 949-287-9525. 949-287-9525. And you can find me on Mortgage Solutions website as well.
Richard, thank you very much for coming on the show again. I really appreciate it. Always a great a bit of information, especially about some of those products that I had not known about in the rural area. Thanks very much.
Yeah, it's my pleasure. I'm happy to help, and hope everybody stays healthy, and take care.
Thank you. And that's Richard Impietro from Mortgage Solutions. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for watching each and every week. We're on 5 stations in, what are we? 5 stations, 3 different states. We're in Las Vegas. We're down in Albuquerque, New Mexico. We're in the Inland Empire in Southern California, San Bernardino, Riverside counties, as well as up in the Tahoe, Nevada, and California side. Really appreciate you listening. We're on 8 major podcasts. Gerald, do you have those podcasts handy?
I sure do, Jeff. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and soon to be Podclips.io.
Excellent. And YouTube, if you go there, you can see the show. Yep, we shoot it for TV and a couple of radio stations. Jeff Barton, the Mortgage Voice. Also on a daily, we are on LinkedIn and Facebook, and I'm exhausted. But I want to bring our next guest to the show, who is a terrific and dynamic real estate agent in Southern California. She works for HomeSmart, PV and Associates. Her name is Shogig Andropoulos. Did I pronounce that right, Shogig?
Yes, you did, and I go by Shirley to make it easy for everybody.
I love your name, but I'll call you Shirley. Don't call me Shirley. I know that's a stupid joke. Okay, so anyway, thank you, Shirley, for coming on the show. Thank you for coming on the show, and I do appreciate it. Tell me a little bit about your business, about your brokerage, where you operate, and how you're doing.
Okay, great. I have been in the real estate industry for about 28 years combined. I started right out of high school. During college, where I worked for at the time, Great Western Bank. It's a dinosaur now. It's extinct, yep. But I was a receptionist, and then I went on to become a loan processor, then became senior loan processor. Then from there, I went into the escrow part of real estate, which was fun and exciting. And being in escrow for quite some time, for about 4 years approximately, I started to realize those commission checks I was cutting for realtors were pretty hefty and wonderful.
Yep.
So in 2000, I got my real estate license. At the time, I was a new mom and a working mom, and I thought, I want the flexibility of working around my life, and it just worked out. And since 2000, I've been full-time, love what I do, at first it was about the paychecks, as I said, but then shortly after I realized it's much more beyond that. It was more of a service-based for it was more service-based for me because I started loving my clients and that moment when I got to hand over the keys to them.
Let me ask you a question, because real estate agents, they reach a burnout rate at about 10 to 15 years. You sound excited still about it. Is it because of the marketplace, the clients? What keeps you excited and engaged, especially in a market where there's not a lot of housing to sell?
Sure, of course. I did real estate consistently, 60 to 80 hours a week until about 2005, 2006 when the market crashed. And that was a tough time for a lot of real estate agents. And that was a little discouraging at the time. But I stuck with the industry. I went back into the escrow part of it. And for me, this market right now, it's not very healthy for me as an agent because it's just so much competition. Like you said, new agents coming in, which is wonderful. It's just, there's a little sense of unfairness as well with the way the market is trending. But it is a time in real estate. It's not a permanent status of real estate. So if we could all remember that. For me, it goes back to serving my clients. I'm also a real estate investor myself. I have my senior certification. And once I started to be the client as well as the realtor, I started to feel, get a better sense of what's really needed when you're working with people. And I try to be the gatekeeper for my clients with emotion and with any issues that rise up. I always come to them with a solution base. I don't go to them with a problem. And I think for me, the market tends to go up and down, year by year, but my excitement comes from within and what I'm able to do for my clients.
No, that's excellent. I mean, real estate is hard, and you described the job in a very easygoing method, but I know what it is. You, as the quarterback for the entire deal, have to deal with not only the other side, the seller or the buyer, depending, but you have to deal with the escrow agents, the title agents. You have to deal with the loan officers, all the inspectors, making sure that that information is funneled in a way that's positive and with solutions is not an easy job, and it takes a very seasoned person to do that, don't you think?
Absolutely, it does. It's a very emotional time for buyers and sellers. For sellers, it's their largest investment they're handing over to you to take care of. For buyers, it is their largest investment in their life that they're purchasing. And there's so much emotion, so much involved financially. There's a lot of information coming at them. And if you do not deliver with tact, and if you don't deliver with grace, you don't deliver this information with compassion, it can go south very quickly. And so it's very important to be able to shuffle the different hats that you need: psychiatrist, sometimes babysitter. You want to hold their hand, therapist, however. But predominantly, my job is to provide information. It's not to sell. And so when I want to be able to provide the information to my clients to empower them to make the right choice for their future.
What do you tell a buyer first time out the door when you're taking them to a house? What's the main thing you want to get across to them when you're first meeting them?
So first, it depends on what they're qualified for. That's the most important. Malibu Funding is my primary lending company. I love them. Bill is amazing. And we work as a team to make sure our clients are ready and armed with a pre-approval. Most of the time, they don't understand why. So it's my job to let them know it's their armor, their shield that will get them ready to take that next step. That's the first thing I do before I take them out to a home, because I never want my buyers to bite more than they can chew. And so Bill and I work together hand in hand to make sure that they are, all the I's are dotted and the T's are crossed before we step into a home. And the last thing I want to do is show them a home they cannot afford.
Absolutely. What's the first thing you tell a seller when you're going in for a listing appointment?
I let them know that I'm always going to be honest with them. I do not sugarcoat numbers. My job is not to just put a sign in front of their home. My job is to make sure I sell their home and understand why they need to sell.
No, I think both of those answers are professional. And I think when I get into any kind of a real estate or a loan transaction, working with other professionals are really, it's a gift, because many times you don't work with professionals. What you work with is people with high emotion who go up and down with the transaction and the difficulties that you face. And in those types of transactions, it's very, very difficult, because you're trying to hold your own client and their emotions in a level so they can make better decisions. And you're also trying to control the other side. And that's difficult. Do you run into that much nowadays with a market like this?
Unfortunately, it is very high nowadays, due to the fact that going in, having multiple offers, trying, every second counts, trying to beat deadlines to get offers in, trying to match the next offer. It is very volatile. It's very high right now with that, because the problem I'm seeking is the we is not, the team concept is lacking right now with a lot of my closings. And so it's my job to always be even keeled and to continue going towards the we, even though the other agent is not feeling the same.
Yeah, that's the most difficult part in the business.
It's our client.
Hey, Shirley, could you shout out your phone number for people and a way they can get in touch with you for your services? You're obviously a terrific, experienced person, and people should know how they can reach you.
Thank you. I actually service two markets in California. One is the Central Valley, San Joaquin County. My number there is different than the Southern California, because for some reason it makes a difference for agents, not for people.
No, I
understand. My number is 650-619-8434. And then in the SoCal market, I do have a team in both markets. The SoCal market, I do Ventura County, Orange County, and Los Angeles County. And the number there is 818-398-2757.
Excellent. Okay, Shirley, thank you very much for coming on the show. We appreciate it. Want to have you back, especially as the year gets going, to see where we are in those two markets. Thanks for coming on the show.
Thank you so much. Bye-bye.
Thank you. Bye, Shirley. And that's Shirley Andropoulos from HomeSmart PV and Associates. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening each and every week. We're on a number of different stations in a number of different places, and we do appreciate when you click into the radio station, you tell them you like me, or you join either through Facebook or LinkedIn or YouTube or any of the podcasts that we're on. We're on the 8 major podcasts, and soon to be, what's our new affiliate online?
It's called podclips.io. Podclips.io.
Okay, now for those of you who don't know what that is, if you go there, podclips.io, there are a number of different professions there, a number of different ways by which you can gain information. This is a podcasting center, and certainly the ones in real estate and mortgage are very informative. I spent some time there the other day myself, getting used to the format and how they do it. It's a good bunch of people, and if you're out there and you want to check something out, especially in what we're doing, please do. Again, Jeff Barton, Mortgage Voice. Okay, so let's get to a couple of just quick facts about what's going on in the business today. The real estate agents. I don't know. Did you see this, Daryl? That the real estate agent that flew into the Washington D.C. I guess riots or the takeover to see Trump speak, and then went in and got involved in the assault on the Capitol, and then eventually got arrested.
Well, a lot of people that happened to, I didn't know anyone in particular, were real estate agents.
Yeah, well, it's funny. I saw it today that the person, she had flown in on a private jet to go to the event,
One from
got
Texas?
into the event. Yes, from Texas. Well,
Yeah.
apparently there were two other real estate agents who also flew in with her in Texas. All three of them have been charged. All three of them have lost their jobs with the companies they were with. Now, I
Probably
don't know
their,
whether this is going to enhance their, what's that?
probably their licenses as well.
Well, it's interesting. We'll see, because I think in a state like Texas, this may brandish your particular, career as opposed to be a dent in it. And anyway, I just thought it was interesting that they made a point of saying real estate agent as opposed to, that guy's a bricklayer. The person over there, he's a banker. That person over there is an ex CIA agent. No, they just anyway. Real estate agents get blamed for a lot of stuff, and I guess in this case, probably rightfully so. But I just thought it was an interesting. New York City real estate. Okay, one of the problems in New York City, as a lot of major cities have figured out, we mentioned it earlier on the show, rents. Rents aren't getting paid. Companies can't pay the rent. PPP loans aren't being used towards that, or they're just abandoning spaces. 30% is the vacancy rate in New York office space, apparently, at this particular moment. So what does happen to New York City, to Chicago, to Los Angeles, to Des Moines, to St. Louis, Missouri, to Miami, Florida, all these places where commercial real estate at the center of the metropolis is what has driven the tax base, as well as a lot of other different things. When companies move to a home-based business, or at least cut down 50% of the space, they're trying in New York City to figure that out right now. The death of New York City has been predicted from a number of different sources because of the falling real estate prices, because of the fact that most people are going to either move away and work from home permanently, or the companies themselves have decided, you know what, it's time to downsize this big office here in Manhattan. Interesting to understand. It is a trend, but in what I saw today, now I was watching Bloomberg, and I was watching CNBC, a couple of the other business channels, as well as Housing Wire, which is an online site if you want to learn more about housing on a daily basis. They've got great podcasts, great information. It's cheap too, it's not expensive. Or you go to Mortgage News Daily, which is free. All of these talk about what's happening in the real estate market in major cities. It's, again, interesting to see what will happen. On the interview I saw today on Bloomberg, they said that they thought, now granted, these were real estate agents and real estate brokers that were saying it. So they were saying, oh, no, New York City will definitely come back. We came back after 9/11. We came back after other disasters, and we will come back after this one. I tend to think so. New York City is a destination as well as a business hub. So I'm tending to think it's going to be that way. But I have a niece who is in financing. I think she's at not Kidder, but one of the large houses. She sells bonds for municipalities. She's still at home. She's doing all her trades at home. So maybe it is a way by which you can do this at home without having to spend it. I personally know that there are many people who enjoy going to work at an office, but that's just another thing in the news to use section. Although mortgage credit availability is the lowest since it's been in 2014. Now, what does this mean? Okay, since 2014, we've seen the credit availability. You may have seen it if you're looking for a loan right now. That and I think Richard alluded to it, or one of our last guests, Shirley, maybe, that the criteria to get a loan has increased. The FICO score may have increased, or your loan to value may have increased. How risk, and I asked Richard this, the risk that you take as a lender, or the end buyer, whether it's Fannie or Freddie, or whether it's Ginnie Mae, whether it's a non-QM type of investor, you look at the probability that this particular loan will be paid off, or that the monthly will be paid again and again and again 360 times. I mean, obviously, if you're a lender, you want that loan 360 payments, because that's where you make your most money. Normally, it's 7 to 10 years a property is bought and sold. So they look at risk during that time frame. Since 2014, they've obviously looked at risk as, greater than it was prior to that. Well, recently, especially since COVID, the risk on lenders is even greater, which means that this availability of funds. If I'm going to lend you money and you don't have the criteria that I'm now expecting you to have, I'm not going to lend you the money. That's essentially where it boils down to when you're a borrower out there and you're looking for a loan. So you have to mitigate that with, okay, I have more money in the deal. Okay, I have, instead of 3 months reserves, I have 6 months reserves or a year reserves. If I have a FICO score that's 580, well, maybe I should get it up to 680. And how you do that and what you do in order to do that, there are many, many different companies, many different ways that you can go about improving your FICO score. But I just thought it was interesting that in of itself is interesting, right? The lowest level of credit available. That means banks aren't lending money at the rate they were since, mortgage rates got very, very low. So you've got extremely low rates, but you've also got criteria that make it harder to get the loan. It's frustrating for those people who are certainly making enough money, but maybe have other mitigating circumstances that they just can't get the loan because they have a bad FICO score, as I said, or maybe they're in a transitional job. Maybe they're working some other kind of job that doesn't get 100% use for the loan to value. Yeah, it's difficult. Okay, the 10-year. We talked about the 10-year, talked about bonds in general. Bonds are on an upward swing in terms of yields, although today they kind of went back down, which means that particular source is good. Now, what happens on a worldwide basis when countries sell debt? 10-year note is debt. The U.S. government sells the debt, and they will pay you 1.158% in 10 years for that particular money that you lend them. Now, you may say, well, that's terrible. Yeah, well, go to some other countries. Go to Japan, where you're paying them, right, to house your money, so you're not losing on an inflationary basis. That's right. There are negative interest rates out there. It's not a good thing, and that in the U.S. we never want to see that because we're the kind of the benchmark. Although we've seen competition from other places, from other countries, but until that happens, U.S. debt is still primary debt to be purchased around the world. The 10-year notes are really golden. I mean, the 1 year, the 2 year, 10 year, the 30 year. Yeah, but the 10 years where it's at, and currently we're still above water. We're actually better than we were a year ago. Not a year ago, but let's say 8, 9, 10 months ago when we were at half a point. Let's see, 6 out of 10 home buyers are millennials. That's a big deal because they're the largest pool of buyers out there. If you're a millennial right now and you're looking to buy a home, you're not alone. There are many, many, many millions of borrowers out there looking to borrow, looking to buy a home. And I think that's a good thing. Listen, thanks for listening to the show. I'm Jeff Barton, your voice in the mortgage industry, and we will see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.